Moody's analytic chief economist Mark Zandi joins us now. Mark, it is hard to believe that we are here with 2.9% on core PCE. We just got this GDP report at 3.3% annualized, even higher nominal GDP. I mean, I always give you credit because you said soft landing when everyone else was calling recession. So what does the Fed do next?
Well, a cut. It's just a question of when, Sarah. I don't. March, May, that's 6 weeks. I'm not sure it makes a difference. I wouldn't argue with anyone who said March, but my sense is that they'll probably, push comes to shove, wait a little longer, just make absolutely sure inflation is at target or headed to target before they make that move. But we're here, and you're right. Very surprising. I mean, even for me, I didn't expect we'd be at 2%. I mean, in fact, if you look at core consumer expenditure deflator inflation over the past 6 months, it's less than 2% on an annualized basis. So we're here.
We're here. How do they? I mean, will it last? It's hard to believe that they managed to get the soft landing that they wanted, but I don't know. Too much of a good thing?
Yeah, I think we're. Yeah, I mean, there's always going to be a struggle, but I think there's good reason to believe that inflation has come back in. Inflation expectations are well tethered and anchored. Wage growth is moderating, consistent with productivity growth. All the things that one would look at to gauge whether inflation is going to remain stable and low are in place. So I think we can state with some confidence, but. Things happen. One thing I do worry about is oil prices. Very hard to forecast where they're going. A lot of cross currents there in global markets, and given all the geopolitical threats. So if oil prices go back up, that could scramble things at least for a while. But barring something unforeseen, it just feels like inflation's back in the bottle.
Is it back in the bottle though for ordinary Americans? Because I talk about all this progress all the time and how Secretary Yellen is very thrilled with these results, and President Biden should be very happy. And then everyone says, you don't know what it feels like. We're still paying much higher prices than where we were several years ago. We're still not at the point we're all the way back down. People still are feeling the effects of high inflation, and they're pointing their finger at the administration for fueling it.
Well, you're right. I mean, the inflation, the rate of growth has slowed back to the Federal Reserve's target, but the level of prices is obviously a lot higher than it was 2-3 years ago. Particularly for staples. I think food is kind of at the top of the list of pain points for many Americans, particularly lower middle income Americans. Rent is also a lot higher. I mean, rents have gone flat to down over the last year or so, but they're still way above where they were 3 years ago. In energy also to some degree. So, the staples that people need, prices are a lot higher for those things. So I get it. And it is a lot of financial pain. Good news, though, is that people's wages across the wage distribution, high wage workers, low wage workers, their wages are now rising much faster than the rate of inflation. So with each passing month, that financial sting that people are feeling should feel less painful going forward. And I think 6 months from now, a year from now, people won't be as concerned about inflation as they were. Now, just really quickly to your point about blaming the administration, I don't think that's fair. I mean, I do think early on when we got the fiscal support, that did support juice up inflation, but that was hard to remember back then. But back then, that was desirable inflation. We had been through a period of a decade or more of suboptimal inflation. Here we got the inflation we were all hoping for. But since the last year, 2 or 3, it's more about the pandemic and Russian war. It has nothing to really do with fiscal policy.